You need the real story and what steps to take to stay safe before a second and much more destructive economic meltdown possibly strikes the United States. And that's why we are joined today by one of the three economists who has been helping Americans prepare for the coming crisis. Bob Wiedemeyer, thank you for being here. Basically, your message in Aftershock was that the recession was bad, but that the worst was still ahead, and Washington is still ignoring the problem. Is that correct?
Well, yes and no. I do believe we have some very tough times ahead for our country. And most in Washington are refusing to address the true scope of this situation. And millions of Americans will face some difficult hills to climb to avoid getting caught up in this economic disaster I see unfolding. There is no getting around that. We are past the point of no return. And people are starting to realize this. CNN released a poll just a little while ago that stated 48% of Americans see our country headed into a second Great Depression in a year or two. I slightly disagree with that timeline, but not that diagnosis. Fortunately, right now, we're still in a critical period. A few simple decisions can be the difference between personal economic obliteration and financial prosperity. This is a situation to be taken very...
But you didn't stop there. In 2009, you released the best-selling book Aftershock, which warned Americans of dollar and government debt bubbles that were set to expand from 2009 to 2012 and burst around 2013. Well, in the last year alone, the dollar has dropped, and since Obama has been in office, we've piled on another $3.7 trillion onto our already dangerous federal debt tab. And serious minds like billionaire bond investor Bill Gross believe that the total tab could be $75 trillion or more when you account for Medicare and Social Security. He's even gone as far as to say that the United States will default on its debt while picking the pocket of every citizen through inflation, dollar devaluation, and interest rate games. Now, Bob, our viewers would be in a better place right now if you were wrong on these predictions, but unfortunately, you've been right all along. Okay, Bob, let's talk about the future. What's in store for our economy?
Well, to put it simply, we now have a situation where the medicine has become the poison. The federal government and politicians on both sides of the aisle have done everything they can to give Americans the appearance of a recovery. They bailed out their friends at the banks and automotive companies, they've kept interest rates at historic lows, and they allowed the Fed to turn on the printing presses and drastically grow the monetary supply by 300%. And all this has done is delay the inevitable. We will all soon see that while printed money has been the medicine of the so-called recovery, that medicine is about to become the poison when the dangerous side effects kick in.
But this doesn't seem to be hurting the stock market. As a matter of fact, since bottoming out in March of 2009, it's up as much as 94%, and many are saying that it could top pre-recession levels in the near future. So couldn't that be a sign of a possible recovery?
That's all an illusion. Look at this chart and you'll see the stock market's initial gains simply shadowed the money printing trail. And it won't be very long before this money from heaven becomes a path to hell, that hell being inflation. You see that 300% increase in the money supply we've experienced, well, much of it is sitting in excess reserves at the Fed and with the big banks. These funds haven't made it into the markets and the economy yet, but it's a mathematical certainty that once this dam breaks and this money passes through the reserves and hits the markets, inflation will surge.
So why don't they just stop printing money?
Well, because they don't think it's a bad idea. They've seen how it's propped up the stock market and a good portion of the economy, and they believe they're fighting off deflation. They aren't worried about inflation. And some of the more liberal-leaning economists are calling for even more aggressive money printing. For example, Paul Krugman has stated he thinks the Fed might need to print $8 to $10 trillion to save a weak economy. That's preposterous, and to think that Krugman was awarded a Nobel Prize in economics. Frankly, liberal voices like his are winning out over more fiscally conservative ones such as mine.
All right, Bob, so how bad do you see inflation getting?
Well, I dedicate an entire chapter of the new edition of Aftershock to inflation. And it's a very serious issue which needs a very long discussion. But I'll just say that by the end of 2012, we will likely start to see the first signs of aggressive inflation. I'm talking about 10%, using the Fed's calculations, which we all know are drastically underestimated. And from 2013 through 2016, it's going to get much worse.
Are you talking about hyperinflation?
Absolutely not. That's a bit extreme. We definitely will not see hyperinflation. Hyperinflation is 50% a month or thousands of percent a year. We aren't Zimbabwe. And don't listen to any economist who says it'll get that bad for us. But we absolutely could see 100% annual inflation for a 3-year consecutive stretch, which of course would be a complete disaster for those who are not prepared.
100% for 3 consecutive years? That seems unfathomable. I mean, isn't that extreme?
Well, for Americans it is, but what many don't know is that the most damage will be felt between 10, 20, maybe 30% inflation. After you get past 30%, it'll just be bad all over. You eventually become numb to the effects because there isn't much left to take from you at that point.
How can 10 or 20% be a harder hit than 100%?
Well, once you hit 10% inflation, 10-year Treasury bonds lose almost half their value. And by 20%, any value is all but gone. Interest rates will increase dramatically at this point, and that will cause real estate values to collapse. And the stock market will plummet as a consequence of these other problems. So after 10, 20, even 30% inflation, the vast amount of damage has been done.
All right, so you just touched on interest rates. Yeah, not so much. That doesn't sound like smart foreign policy.
It's not, and it will end whether the U.S. wants it to or not. Based on my analysis, I predict foreign investors will begin to significantly lose confidence in their U.S. holdings sometime during or shortly after 2013. China is already beginning to worry, but this will get much, much worse when we hit 10% inflation. And by 2016, a mass exodus of foreign investment could very well occur in the United States. Whether we like it or not, we need foreign investment in our stock and bond markets to keep them strong.
All right. Do you think one of these revenue-boosting options will be to raise taxes?
Unfortunately, yes. And it won't matter who's in the White House.
Let's discuss one of those problems. Housing. Recently, the Wall Street Journal announced that national housing prices fell for 57 months straight. So what lies ahead for homeowners?
Well, in the immediate future, we will continue to have a slow fall. Median housing prices dropped 8.2% in the last year. In fact, the beginning of 2011 brought about the worst single quarter in real estate since the recession began. But some people may get their hopes up once our market improves or at least flatlines. But midterm foreclosure expected to jump 20% this year. So I believe people will lose, on average, about another 5 to 8% of their home's value in 2012. Some places will be much worse and some will be better. And long term, we are going to witness a massive collapse, I believe even worse than the first. Right now, research shows that more than 1 out of every 4 homeowners is willing to walk away from their homes. Once the inevitable interest rate hikes set in and the values of people's homes drop even further, that figure will jump even higher.
Because paying off a mortgage won't make as much sense as simply walking away and renting, right?
Exactly. The scope of the damage will be determined by how high interest rates eventually go. Housing expert Robert Schiller believes home price could fall 25% in the next 5 years. I think it could be even worse. Consider this. If mortgage rates at a reasonable 7.5%, it would basically mean home price would have to decrease by as much as another 32%. And 7.5% is very reasonable. I mean, my parents' mortgage in 1968 was 6.5%. When I graduated college, it was 15%.
All right, Bob, in a few moments, I'm going to tap into your brilliant mind so our viewers can get your investing, personal finance, real estate, and even jobs. Okay, so put a specific number on the impact this will have on the stock and job markets.
Well, in the first edition of Aftershock, I laid out a situation where we could see as much as a 90% drop in the stock market and 50% unemployment. That is the worst case scenario, and I stand by that assessment. But let me make it clear that regardless of how bad it gets, this will be temporary. We will recover from all of this eventually.
Bob, what will life in America be like if what you predicted in both editions of Aftershock comes true?
Well, I believe many Americans who don't listen to my advice in this new edition of Aftershock will lose most of their money. But these people won't starve in the streets. Compared to most countries, America and Americans are still very rich. Even if our GDP dropped in half, we would still have a $7.5 trillion economy. But many people's savings could be drastically lower. Just about everybody's home will be worth much less in 5 years. Bonds that back up a lot of pensions and life insurance policies will be destroyed. Pensions will become unstable. Some forms of life insurance could be eliminated. The stock market will plummet. And all of this equals more job losses. But people won't be rioting in the streets, although there will certainly be many angry demonstrations like we recently had in Wisconsin. Remember, we didn't see rioting in the Great Depression. The pain was felt at home, and that's where it will be felt this time as well.
And really, this is all because our government has not learned that, as you put it, money from heaven is a path to hell. You aren't exactly painting a very positive picture for our audience there, Bob.
Well, look at it this way. If you had pneumonia and all your doctor did was tell you to not fret and take 2 aspirin and you're cured, would you still use that doctor? Of course you wouldn't. This situation's no different. People need an honest diagnosis concerning our economy and the best medicine for keeping their money healthy and safe.
You're right. So let's discuss the ways our viewers can protect their wealth in the troubling times ahead. But let's focus on solutions right now. What should our viewers be doing to stay safe?
Well, first and foremost, I advise people to stay away from real estate. Real estate has not hit bottom. Higher inflation, mortgage rates, and unemployment will suffocate the few breaths remaining in the housing market. In my opinion, strictly from a financial standpoint, people should consider selling their homes while they still have a chance and rent instead. But I understand that's not practical for most people, and the emotional attachment to a home goes beyond financial matters. So if you're stuck in an adjustable rate loan, I advise you to immediately refinance into a fixed rate, and I mean now. Don't put this off, do it now.
Okay, should people staying in their homes who have a fixed rate mortgage look to pay it down faster?
Absolutely not. Higher inflation in the future means you will be repaying a cheaper mortgage since the dollar will be worth much less. So stick to the minimum payment for now and use that extra money for shrewd investments, pay down more important debt, and definitely save as much as you can for a rainy day, because we'll see quite a few of them in the years ahead.
What about non-real estate loans?
Well, the most important one is your car loan, especially if you're still working. An average car loan for Americans now is about $12,600, so it's not a small chunk of change. But a repossessed car is no good for you now or when you need to secure financing for another one in the future.
What about credit cards?
Well, many credit cards are simply adjustable rate loans. Even the fixed rate credit cards have loopholes that allow them to hike your rates. So an interest rate rise, so will rates on many of the cards you are holding. So pay those off as soon as possible. If you take my advice and pay just the minimum on your mortgage now, you can use the newfound extra money to pay your credit cards down faster.
All right, how should our viewers approach insurance?
Well, a good topic for this discussion. Once inflation hits 10%, all life insurance policies will be susceptible to very big losses due to their heavy exposure to long-term bonds, commercial real estate, and stocks. Some insurance companies could even crumble. So given our current situation, in my opinion, it does not make good financial sense to own whole life insurance. If you do, you may be able to take out a lump sum payment now. This will be much more valuable to you to properly invest now than when inflation really kicks in. Check to see your policy details on that, though. You can also focus on term life insurance instead, since it's much cheaper.
You know, it seems people are putting off retirement until later and later in life. As a matter of fact, Wells Fargo recently released a survey that says people in their 50s, on average, only have $29,000 saved up for retirement. And with Social Security, Medicare, and the unreported tens of trillions of dollars in future costs pressing down on our economy, the safety nets many have relied on may not be there in the years ahead. So for our viewers who may still be working and do not have enough saved up for a comfortable retirement, if we have a serious spike in unemployment, what careers will be the safest in the years ahead?
Well, this is truly a sad epidemic. Given the pullback in income growth, as well as other economic factors like inflation and a weakened dollar, the retirement age would now have to be raised to 73 for average Americans just to maintain the same standard of living in their golden years as people in the 1940s enjoyed. Since the average life expectancy is currently about 78, millions will have to work until they drop dead instead of enjoying their golden years. Plus, Washington seems incapable of having an adult conversation on the entitlement issue. So I personally see people working later and later into their lives because they have no other choice. However, jobs will be very tight, especially for people over 55. So for those seeking job security during the coming crisis, the necessity sector is the place to be. Now this is composed primarily of healthcare, education, utilities, basic food, basic clothing, and government services. Unfortunately, these aren't the highest paying jobs.
Whether people are... What about other investments?
Well, other precious metals like silver and even platinum are good choices over the long run. Until serious inflation hits, short-term bonds are okay. After inflation really sets in, you will need to keep cash in short-term investments such as money markets, tips, and T-bills. Their low returns don't exactly make them very attractive, but they will protect you against inflation much better than the longer-term debt. I highly advise our viewers to stay away from long-term bonds. And let me stress that again, avoid long-term bonds, okay?
What about some unconventional investments that our viewers may not have considered before?
Well, foreign currencies are a great play right now for investors. I like the Canadian dollar, Swiss franc, and the Nordic currencies, such as Norwegian